Everyone, hope you're doing well. Welcome to the video today. I've got 4 stock updates for you guys. So you guys that like a video where there's a lot of stocks talked about in one video, 3 or 4 minutes on these companies, all news that's kind of happened in the last 24 hours. You will enjoy this one for you guys. First of all, what has been interesting, stock market is set, well, it looks like it's going to have a good day today. A lot of the futures are up. Dow's up 0.5, S&P's up 1.1, Nasdaq's up about 1.6%. Obviously, you guys will see it when the stock market opens, if that's reflected in the share price. At the moment, it looks like it, but as we know, things can change. Bit of a surprise that came out over the last 24 hours. US trade court blocks Trump's tariffs. So obviously, when you think the drama is done, there you go. I think there's still a lot more to play out in this whole tariff situation. Although what it does say is when we look at the UK and how quickly we were quick to bend over and accept the tariffs and get a bad trade deal, it looks, once again, not a great reflection on the UK. Getting on to the first one that's making a big move, though, Nvidia, up around about 5% in pre-market. Good thing for me is that it means AMD is also getting lifted up by that news, and that's up around about 3%. Nvidia, really impressive earnings last night. Like, we're talking probably 10 out of 10 earnings from them. Really nice EPS beat. Revenue beat as well, really nice. 69% growth. Let's just call it 70. They basically said a lot of the reason why is the Blackwell. Blackwell is getting a lot of success. And the great thing is, obviously, we know AMD's competitor to Blackwell is still yet to come. So good news to AMD when that happens, because hopefully that means they can have the same success. Shows that companies are not cutting down the spending. The AI spending just continues to absolutely surge. And as well as that, I don't think this is getting enough credit. The next quarter's guide was actually really good. So the revenue was in the consensus of 45 billion compared to the 45 billion in consensus, plus or minus 2%. But this is the big thing. The outlook reflects a loss in H20 revenue of around about 8 billion. Now, the thing is when you do start looking at Nvidia's current guide at the moment, and if we go back onto Wayback Machine, before it came out that the H20 was going to get stop getting sold to China, the consensus for that quarter was actually 47 billion. So when you look at that point of view, is that analysts didn't even hardly budge their targets down. Like 2 billion, they budged the targets down by. And yet they've taken out an 8 billion impact and are still going to get to that point of view. Imagine if that wasn't taken out, and another 8 billion on top of that. Nvidia's next quarter, without that, realistically, you're coming in towards like the 53 billion mark, massively ahead of expectations. So really strong numbers from Nvidia there, and obviously as well, AMD's kind of seen a bit of a bump because of that situation, which is also good for me at the moment. Next one was ELF. Talk about a volatile one in the pre-market or after hours after reported earnings last night. Look at this. So they reported their earnings. The stock went down around about 14% at the peak time. And now in pre-market, the stock is actually up 11%. What a rebound that is. We're talking nearly an 18% swing on the stock price in ELF after they reported earnings. And I got to say, I looked at the numbers and I thought, okay, the actual headline numbers actually look pretty good. EPS was a decent beat. Revenue did beat by 5.98 million, but still the revenue growth is only 3.6% year over year. This is way from what they were growing at previously with insane growth. This is quite poor growth when you look at it from that point of view. The big concern I would have is that they pulled their 2026 outlook and they blamed it on the tariff situation. Now, I don't personally think they should have done that, or they should have potentially given a little bit of a guide on the next quarter. For me, that says to me that there's some concerns going on inside the business, and the easy get out clause to do that is by blaming the tariff situation. I look at someone like a Warpaint, for example, that I'm invested in. I've not seen them pulling the outlook because of the tariff situation. And in my opinion, the reason why is because I think the numbers are too tricky for them to get to. They're at 3% at the moment, but if we do look at what analysts are expecting this year, they're expecting revenue to go up to 7% to 12%, and the full year guide is actually 12% growth. So they've got to accelerate massively this year. And I wonder if ELF have just seen this big, massive slowdown. They've gone, bloody hell, these numbers we've got to do are a little bit hard. What can we do? Okay, let's actually blame the tariff situation, gets us out of doing this guidance, and then if anything happens later in the year, we just go, well, we didn't give any guide. I personally think that that's actually a bit concerning from the ELF numbers last night. Now, what also the market doesn't like is they made a 1 billion purchase for another makeup brand. Now, when you're a 5 billion market cap and you're doing a 1 billion purchase, it's a big purchase. And the stock market never likes big purchases, and that's probably why the stock got thrown down so big at the early part of the after reporting earnings. But yeah, overall, I looked at the ELF numbers and I thought they're not amazing. And the fact of a full year guide pull, I think is not great. And I look at ELF and realistically, you look at it and it's still 24 forward times earnings for a company expected. Now, if this is where I could go wrong with ELF, if they do these numbers, this stock is actually okay value. But right now, with the numbers that ELF are doing, I think that's maybe slightly a little bit expensive. And especially when you look at someone like a Warpaint, which I personally chose over ELF, I think Warpaint was the better purchase than ELF. Warpaint's about to grow 25% year over year. And next year is supposed to grow 13%. And right now, Warpaint's currently trading at 17 forward times earnings. So Warpaint is 30% cheaper than ELF and hasn't really got that much issue. Even when you take Warpaint's acquisition out, it's still growing a lot faster. I mean, what we're talking, 3-4 times faster than what ELF is currently at. So yeah, for me, I looked at the numbers and I just thought, well, if ELF's currently valued at this and Warpaint's doing better numbers, I think I'm just more bullish on Warpaint. So yeah. Next one, Dick's Sporting Goods. So I only ever look at this one because I own shares in JD Sports, and I looked at Dick's Sporting Goods earnings last night and I thought, okay, these numbers are not the best. EPS was a big miss, revenue was a miss as well. And once again, it kind of just points to what JD is seeing at the moment, and JD is seeing a weak environment out there. And once again, Dick's are kind of saying exactly the same at the moment. But what also I look at Dick's is currently they're trading at 12 times forward earnings. Obviously, you look at JD Sports at the moment, and I think they're 8 times earnings. I think on a forward P. I'll just have a quick look what actually the forward P is on JD Sports at the moment. It could be actually lower than 8. It could be a 6 or a 7 right now. Yeah, 7. So I just look at Dick's Sporting Goods and I'm looking at the numbers. The numbers are not great. Probably maybe even a little bit weaker than what JD Sports are. And yet the company, you look at Dick's Sporting Goods and it's nearly double the value of JD Sports. So if anything, I looked at those earnings that came out, I think Wednesday, and I went, just shows that JD Sports is still pretty good value out here as well. Hollywood Ball's having a bit of a drop today, down around about 9%. I personally can't see why. I can see why. I can see why the market's pushing it down. I personally don't agree with it. So they came out with the numbers, like for like, strong at 2.1%. They said that it was negatively impacted by the movement of Easter, and also that there was the leap year, so they lost a trading day. So if you take that out, it looked actually pretty good. Canada growth just looks absolutely insane. This is where the growth's going to come from in the next few years. Like for like, up 13%. I think they've got somewhere down here like what Canada actually grew out, which is just absolutely bonkers. But even if we look for like, yeah, incredibly strong. Underlying adjusted EBITDA pre-IFRS 16 grew 8.8%. But if you do take the accounting charges that you have to put in, it was a little bit lower. I can't remember what it was, but there was a lot of one-time charges. There were also a lot of cost ramp up as well. If you look at like the admin expenses as well, so there's a few costs coming in at the moment. Obviously, we know like the likes of some of the cost inflation that's gone on. Some of these retailers is pretty high, but overall, I looked at the numbers and I thought, okay, you can see it. The UK business is still doing very well. You can look at the Canada business; that's doing very, very well. There's some costs coming in at the moment. If you take the costs out, if you look at an adjusted EBITDA point of view, it's still very strong. But obviously, you've got to recognise some of the costs here. And I looked and I'm thinking, I saw it before when the market punished the stock for good earnings, but there was a lot of investments going in for future growth, which from Mercado Libre, I mean, when they put, this stock got pushed down, and then it proved to be a good opportunity. Same again, we've seen the market. I mean, how many times the market goes short-term thinking rather than looking at the long-term going, well, if they keep doing this UK expansion, this Canada expansion, this company's going to do really well. But the market's throwing it down because of some short-term one-off charges. And, you look in a year's time and all those will be gone. And then, the market will be piling back into it again. I saw exactly the same with Mercado Libre. We're seeing the exact same with Hollywood Ball. The thing with Hollywood Ball as well is that, right now you get to pick up a 4.5% dividend. If they do hit the full year numbers, very good growth. If you look at the P ratio, we start going down to a 12 times earnings. I think for a high quality company like Hollywood Bowl, I think you're always looking somewhere between 16 to 18 forward times earnings. So yeah, a drop for me today that just looks way overdone. I can see the market maybe being a little bit upset by the one-time charges, but no, it just completely shocks me how incredible short term the market always seems to go. And I think this is one of the best UK companies, and you've just got an option to buy it 10% cheaper today, even though all the fundamentals inside the business are still going up very well. You know, you look at all the metrics inside the business, still doing very well with Hollywood Bowl. So yeah, I like that one overall. So just yeah, quick 4 updates for you guys. Hope you enjoyed it. And tomorrow I should either do the UK stocks I'm buying or the US stocks I'm buying video. So yeah, hope to see you on that one there. Anyway, thanks for watching, guys. See you in a bit.